Hello, this is Mike Swanson of Wall Street Window. We've got a very special guest meeting. I'm speaking with Ike Iossif, who runs the website marketviews.tv. I've been doing interviews with Ike off and on over the years, and occasionally get his update on what's going on in the markets. We last spoke just a couple days ago, and Ike gave us a broad overview. But today we're going to really dig deep into what his indicators are showing about the state of the stock market. Can the rally continue? Are there signs of trouble or anything? Because so far this year, there's been hardly any decline at all. In fact, as the note that you wrote says, we've gone 340 days without a 5% correction. And frankly, I wouldn't have expected that. We'd be saying that on January the 1st. So I've been surprised by myself. Do you think this environment of low volatility can continue, or what are the odds it would even have happened?
Well, Mike, in this business, we make decisions based upon probability. And if I was to come to you or to anyone near the end of December of 2016 and propose to you to make a bet on an event that had a less than 1% probability to happen, more likely you wouldn't have bet on it. The fact that we have had a pullback no more than 2.9%, which is the smallest since 1914, it means in statistical terms that coming in 2017, the probability of such event happening was less than 1%. Yet it happened. Sometimes it does. You can't exclude out anything. However, this is not a probability on which you can bet the farm on, so to speak. Now, back in April, actually we did two interviews together. One was on April 7th and again on May 26th. And at that time, I gave an upside target for the S&P somewhere between 2470 and 2570, which was to occur sometime between May and October. Now, people who follow me know that I use regression analysis to come up with my upside targets. And back then, I had specifically said on May 26th, when we did that interview, that a super bullish alternative would take place if the S&P climbed above 2470, stayed above 2435, and in that case, price could climb all the way up to 2550, 2575. At that time, this scenario was the least probable without an intervening 5% decline. In fact, the probability of that happening without an intervening decline was 9.8%, 9.87%, less than 1 in 10. What happened since then? The S&P declined up to 2480 on August 7th. It declined down to 2425 by August 18th. And since then, it climbed up to 2561 as of yesterday, Thursday. As of Wednesday, yesterday. So the behavior of the S&P did meet the terms of the most bull scenario. At the same time, as we speak, it reached this important inflection point of 2570. So I think, given the fact that the S&P has gotten to that upside target, it's a good time to look into the internals and see where we are and what we can expect going forward. Now, it's a key thing for me to look not just one thing, but the big picture. So the first thing that we will look at is things that these are things that most people can understand without having in-depth technical knowledge. The first chart on the left is the 80 line for the Dow. The chart on the right is the cumulative volume for the Dow. Now, what we can see is both have confirmed the latest up move. The same thing holds true for the S&P, which is the two charts right below it. In fact, the S&P has gone straight up since mid-August. The same thing holds true for the Nasdaq 100, the NDX, and of course the very same thing holds true for the NYSE. And if we go a little further and we look at something else that also most people can understand without, in-depth analysis knowledge, is the percentage of stocks that are above the 50, 150, and 200 moving average. The first three charts are for the S&P. The one to the left is the number of stocks above the 50-day moving average. The chart in the middle, the number of stocks above the 150-day moving average, and the chart on the right is the number of stocks above the 200 moving average with the S&P 500.
With those indicators, they started to weaken in August, and I thought, well, if they continue to do that in September, that would be a signal that we'd be getting a substantial correction in October, November. But that didn't happen. They shot right back up.
Yeah, my experience with these indicators, and especially with the 150 and the 200, is that the key level from which declines accelerate is the 50%. And if you look at the percentage of stocks above the 150, the number of stocks above the 150-day moving average, it bottoms around 40. In the case of the number of stocks above the 200 moving average, it bottomed right at 50.
Yeah.
Okay. I mean, the next time we talk, I'll have these charts going back 15, 20 years. So our listeners will be able to see what I'm saying. The key level here is 50%. Okay. Now, we do have some minor divergence, but the fact that all these indicators are well above the 50 level, that means, and we have to say this, we have that a grain of salt, that means statistically the market is not facing any major decline right ahead of us. Okay, now let's take a look at the same set of charts for the NDX. Okay, we can see, which is the next three charts, we can see the exact same thing. We have a minor divergence, which in technical terms it means that we're at an inflection point, we have a pullback right here, but not something really major. And the next three set of charts is the number of stocks above the 50, 150, and 200 moving averages for the Dow. The Dow has been on fire, and we can see that the advance has been confirmed by all three. Okay, so if you look now at a longer term view, and the next two charts are the weekly charts going back to 2008 for the Dow, the S&P, and the Nasdaq.
Goodness, the Dow's at the top blue trend line.
Yeah, exactly. The Dow is right at the top of each range. One thing that we need to keep in mind looking at this chart is that if we look at the market experience we have had the last 20 years, which most people who listen to us could relate to. However, if the chart platforms allow it, they can go back 50, 60, 80 years, they'll see the same thing. What you'll find out is that near major tops, indices do not top out altogether. Usually you have one or two that go all the way up to the top of the range, and then they pull back, and then another index does that, and then it pulls back, and I mean there's like a rotation among the major indices.
Right.
What we see right here is the Dow is at the top of its channel going back to 2009. The S&P still has probably another 150 points. Nasdaq may have 400, 450 points. But if you look at these long-term charts and you have X amount of money at risk in the market, it would seem to me that given that we are not at the beginning of the uptrend, like we were at the top of the channel back in 2010, but in 2010 we were only 1 year from the major bottom in 2009. Now we're 8 years from it. So what you need to keep in mind is that there's a difference to be at the top of the channel 1 year from the bottom, and another thing is to be at the top of the channel, near the top of the channel, 8 years later.
Yeah. Well, what do you think of the Warren Buffett has made the statement this year that okay, the Dow's at 23,000 today, but he said it's going to 1 million.
Well, I don't think it's going to be around when that happens, because probably he would have to be 220 years old.
Yeah, we probably won't either then. Oh well, it's just a nice thought, I guess. It doesn't really mean anything.
Yeah, well, and the bottom line here, Mike, is that the weekly charts suggest that there could be more upside potential.
Okay.
At least for the S&P and the NDX. And also, it's clear that the uptrend is intact. It's also clear that we could have a 10-12% correction and the uptrend will still be intact. Okay? I mean, you could see the S&P down to 2,200. That's the bottom of the channel. Or Nasdaq down to 5,000, which is good 1,000 points below where it's at now. And you'll still be in an uptrend.
Well, that's what going in July and August, that's what I thought could happen this fall if the internals continue to climb in September, but that didn't happen. So now I think, it doesn't, as you said, the odds are that it's not about to start today, but it still is likely to happen at some point, maybe next year. I don't know. I'm not trying to predict it.
What I want to point out at this point is that something we've spoken about quite a bit the last 18 months, and that is the VIX. The VIX is back where it was in early 2007. Okay, I have pointed out the last 18 months that what really matters when it comes to the VIX from a major market turning point of view is the divergence on a weekly basis. And I have pointed out how between 2007 and 2008 the market went sideways, yet the S&P, yet the VIX was making higher lows. And that signified a major turn in the market. We have not seen that yet. Okay? Now, something else I want to take a look at is just two charts that illustrate the market from a fundamental point of view. I want to stress, and perhaps I cannot stress it enough, that fundamentals do not make a good indicator for market timing. What the fundamentals tell you is the overall climate that we're in. It doesn't tell you, they do not tell you that this is the time to sell or to buy for that matter, because they can get even worse or better.
Well, but if that's the case, what do they tell you?
What they tell you is something that Warren Buffett said once, which is price is what you pay, valuation is what you get. The fundamentals are telling you, if you buy right now, what is the valuation that you are getting. So these two charts demonstrate just that. The first one, okay, is the margin adjusted cyclically adjusted PE ratio. And what you can see right here is that it has exceeded the valuations in 1929 and also in 2000. So what the valuation that you're getting right now is the highest in history. The second chart, which for me actually is really even more important, is this. Back in 2000, the extreme overvaluation was concentrated on high-tech stocks. But the majority of the market wasn't that overvalued. And that is the reason why small stocks outperformed during the decline. Okay? But right now, this chart, what it shows is, this is the median price to revenue ratio for all the S&P 500 components. And what this chart shows, okay, is that the current valuation extreme is across every decile in the S&P. So we're not talking about, big high-tech stocks being overvalued. We're talking about every single stock in the S&P 500 is at the highest level of valuation in the history of the stock market.
Well, let me add just one little comment about that. Is over the past, time goes by, but over 5 years now, I know you remember Andy, who used to write on my website. He's been involved in buying body shops, not stocks, but small business body shops. They can actually be worth a couple $1 million a piece. And if you go to the bank and you take out a loan to buy a business, let's say a restaurant or a body shop or whatever it is, and you said, I'm going to pay 2.5 times revenue, will you give me a loan? They would laugh at you. You're not going to get a loan. But in the stock market, no one laughs. No one on CNBC is laughing, when people recommend to buy stocks at that price. So it's interesting. You're smart to buy an Apple or a Facebook, but if you try to do that with a loan from the bank to buy a real life business that you can go and enter or something, you would be laughed at.
Yeah, well, if you put it all together right now, okay, is that we have, as we speak, two extremes. One is we have a historical overvaluation, and also we have a technical overextension. And we are at a significant resistance point, which is the 2550, 2570 level that we have spoken about since last April and May. So right here, when you put all these three together, I would imagine that we are at an inflection point. Now, using regression analysis, I can tell you this: if the market, if the S&P 500 was to climb above 2570, the next target, as we spoke about last time, is going to be 2650, 2670. That will take the S&P near the top of this channel, if not right at the top. Okay? So, my point here is this: I believe intermediate and long-term investors, especially those who are near retirement or they are retired already, this is the time where you gradually need to raise cash. If you were in your 50s, let's say you were 55 years old or 60 years old in 2007, in February of 2007, and you have started to liquidate 10% every month. By the time you got to 2008, you have probably been 100% in cash and would be glad. If you are 40 years old right now or younger, perhaps you can afford another bear market. But if you are 55, 60 or 65 or 70, more likely you cannot afford 10 or 15 years to break even. So the market, as I said, the technical show, it can go higher. But from a risk reward point of view, we're at an inflection point right now, and should the market continue higher, the S&P could get to 2650, 2670. To me, it would simply be more incentive to raise more cash.
Right. That makes sense to me, but it's hard to get people to want to listen about the idea of selling anything when the market has not pulled back in so long. Most people are like asleep, and the statistics are that from U.S. investors, more money went into exchange traded funds in the first 3 months of this year than any preceding 12-month period in history. So the average person has the opposite view, unfortunately, that it's time to take on more risks. There's record margin debt, in fact, with stock brokerage firms, but someone will listen.
What everybody does with his money, obviously, it's their business and their job. I mean, our job is to point out the facts.
Right.
The facts are, this year, the market did something that in the beginning of the year, the probability of happening was less than 1%. So my question is, as a rational person, going into next year, what is the chance of this being repeated twice? Number one.
Well,
and number two, given that the market is at the highest level of valuation in its history, what are the chances that over the next 3, 6, or 9 months, it will not top out?
Well, that last time the market traded like this, you said, was in 1914, and the odds of it repeating, it didn't repeat, but something even rarer happened in 1915, and they just shut the stock market down all year. So, I mean, I'm not saying that's going to happen next year, but the point is, rare things can happen to surprise you. That's for sure. And maybe I'm bullish on the long run in gold and own some, but maybe that's a reason to do so also. But so what are your takes on gold?
Okay, on gold again. Let's take a look at what we had said last time. Last time we spoke, which was in our mid-year report, I pointed out that gold had followed the scenario that we were expecting. We had talked about it since actually mid-2015. And the price action, to me, suggested that what gold was doing was putting a long-term bottom, and then what we should see in the second half of 2017 was a multi-month rally, or at least that is what the charts and the technical data suggested. And at the time I had said that if we were to have a decline down to 12,1175, then I would be a buyer, unless the technical deteriorated. And if we got a rally up to 1300, 1325 first, then I would wait for a pullback. Well, since then, we did get a rally above 1300, and then again a pullback down close to 1200. Okay. If you look now at the charts on a daily, weekly, and monthly basis, which is the first set of charts, we can see that on a daily basis, the uptrend is holding well. However, gold is below its 30-day moving average. Now, people who have been listening to me for many years will remember my very good friend, the late Cy Harding. Well, Cy Harding was a brilliant man. And in fact, he is the one responsible behind the seasonality theory, which he perfected by using some other indicators as filters. Now, Cy had come up with a number of moving averages, which are very simple indicators, but he had refined and he had found the ones that work with each different market, because as it turns out is that different markets, for whatever reasons, respond to different moving averages. Now, Cy Harding had found out that the 30-day moving average, the 30-week moving average, and the 30-month moving average were the ones that best showed the difference between, best indicated the difference between a bull and a bear market in gold, whether that is on a weekly, daily, or monthly basis. So we can see right here very clearly that gold on a daily basis below its 30-day moving average. That is short-term bearish, but the uptrend is holding. On a weekly basis, going back to 2009, the uptrend is holding. And we can see that it's pretty much stuck, going sideways now for a number of months. Okay. On a monthly basis, going back to 2001, 16 years, the uptrend is holding. So the intermediate and the long-term picture is still bullish for gold. It is a little bit cloudy for the short term on a daily basis, and that could extend to over the next 30 days. But the charts alone are suggesting that gold is, should be completing a multi-month bottom. If you look at gold stocks, such as the Huey, okay, we can see the same thing. The uptrend is holding on a daily basis, but it is below its 30-day moving average. Short term, that is trouble. But on a weekly basis, going back to 2016, the uptrend is up. On a monthly basis, going back to 2001, the uptrend is up. So, altogether, the intermediate and longer term outlook for gold is still positive. The next three charts, and that's the last three charts that I have, is the month chart for gold going back to 2000, the monthly chart for the US dollar, and the monthly chart for the 10-year treasury yield. Now, here, what you can see is that gold is going sideways, but it is above its 30-month moving average. The dollar, which also responds well, according to Cy Harding, to the 30-period moving average, is below it. Now, usually, but not always, when we get a dip below the 30-period moving average, then we get a rally back up to it. So if that were to happen, we can see the dollar going up to 95, 96. Now, in our last interview a week ago, I pointed out the reasons why the euro, which makes up 58% of the dollar index, could be weak over the next 30 to 90 days, mainly because of the political developments in Europe, especially the results of the German elections. The last chart, we can see that the yield of the 10-year treasury is right against resistance. And if it was to break above, we can easily see it going up to about 3. So, a short-term rise in yield up to resistance, a short-term rally in the dollar up to about 95, 96 could put pressure on gold for the next 30 to 90 days, more likely 30, less likely 90 days. So right now I believe gold and the dollar are also at inflection points. I mean, if the dollar was to fail right here, that was without even making an attempt, without even a oversold bounce, so to speak, up to the 95, 96 level, then the next stop will be roughly about 85. If you correlate that to gold, that would mean a rally above 1400. I would be cautious over the next 30 days. because as I said, the political instability in Europe could weaken the euro, which by default would strengthen the dollar, and that could affect gold. So I am a little cautious. Nevertheless, I think any decline in gold, somewhere between 1220, 1200, at this point, it has to be viewed as a buying opportunity. Now, if we were to get such a decline, and then the technicals were to change, then of course then you would have to go back to the drawing board. But at this point, as it stands right now, any decline in the 1220, 1200 area should be a buying opportunity with a stop somewhere around 1180, 1150. So that's my view on gold.
Yeah, well, this, it's sort of at a sleepy time, I guess, like the stock market. But the funny thing is that those are the exact times when you kind of have to be on top of things and kind of be ready for developments and moves to come. And not so then when they do happen, you're not taken off guard, really. And that's why I follow what you're doing, and glad you're able to take some time and do this overview for everybody. But we also got a special deal for people to subscribe to Market Views. Could you tell people what they can get?
Well, actually, they get two things. One is my midweek and weekly analysis, which we post every Wednesday and every Saturday. But also, they get the interviews that I do with other people in the business. And the reason I do that is because I believe that one methodology sometimes could fail you. No methodology is proof 100%, okay? But when you get different methodologies all together agreeing on one thing, then more than likely whatever that thing is that they're agreeing upon is right. Because they're looking at the same end result from different angles. So to me, it's important for people, in order to have a well-balanced view of the market, to also to listen to other people. And I interview on a regular basis about 20-25 people whose opinion I have learned to respect over the years. This way, not only they get my own analysis, but the analysis of other people like yourself and like Larry McMillan, for example, which is in my view, the best options expert in the U.S. And like Sarah McCollum, who is the founder of the McCollum Oscillator, Dr. Marvin Appel, the son of Jerry Appel, who developed the MACD. So we have lots of people with great technical and fundamental background. Jim Wells, Kai Kaczynski, mentioned a couple of names, Eric Haddock, Jim Carrey, Peter Lightis, great psychoanalyst. So this way, you get not only just one methodology, which is mine, and I said what I use is regression analysis, probability analysis, but also the views and techniques of many other people in this business. So I believe this way people can have a well-rounded and balanced point of view.
Yeah, definitely. And that's what I find interesting, is to listen to the interviews over time too, and see how people's views are adapting, to what's going on in the market, and various people with different perspectives. I find it very interesting to listen to. Thanks for taking the time to talk with me and all the people following all my stuff, and we'll do more follow-up interviews in the future.
Thank you, Mike.